Funding for Market Journal is provided by the Nebraska Soybean Board.
Whether it's spring planting, fall harvesting, or just a drive across the state, soy biodiesel helps a diesel-powered engine operate in a demanding job. Soybean oil from Nebraska soybeans makes biodiesel a renewable fuel that's also environmentally responsible. The soybean checkoff plays a major role in supporting the use and availability of biodiesel. The Nebraska Soybean Board, growing opportunity from the ground up.
Market Journal, television for making agricultural business decisions, is a presentation of the University of Nebraska-Lincoln Extension, where you can know how, know now. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Soybean Board. The Soybean Checkoff, growing opportunity from the ground up.
Welcome to this week's edition of Market Journal. I'm Jeff Wilkerson. This week, Roy Smith is our marketing analyst. Dennis Conley will look at the future scenarios for ethanol production. Bruce Anderson will update us on forage situations, and Aaron Berger will outline the new Rainfall Index for the Pasture Rangeland Forage Insurance Program. We talked with Roy Smith Wednesday about corn and soybean markets. Tight domestic supplies have many eyes to the south in Argentina and Brazil. But since the 2013 South American crop is just going into the ground, the waiting game has months to play out. Roy mentioned there's currently an inverse in soybeans, which could be a bullish indicator, even at $15 a bushel. In regards to the dead cat bounce, when we met on Wednesday afternoon, Roy said the market was doing exactly what it was supposed to be doing.
The day we taped this, the soybean market was up 17 cents on November futures, and that puts the dead cat bounce at 80 cents a bushel so far off the harvest low in 6 days. So we have a little bit left, I think.
We'll talk about the dead cat bounce a little bit later on. You mentioned there's a big inverse right now between November or December and then getting into next spring. Explain to me what that means, what you think it could go to.
Inverse means that the nearby futures are higher than the deferred futures. So that means November futures are higher than March, they're higher than May, and so forth. That is usually a bullish indicator, and the bigger the inverse, the more bullish it is. And right now we have an inverse of about 80 cents from November to July. So that historically is about as good as it ever gets. There was one year back there in 2003, 2004 where it was about where it's at now. So that, you know, that's very positive.
The devil's advocate to that would be it's bullish now, but for how long?
Well, yeah, and you look at the deferred months, March, May, and July, and each one of those is a little lower. And why is that? Because there's another crop coming in Brazil and Argentina, and the market knows that, and the market is saying, sell your beans now, we need them now. The catcher is that chances are, if they need them really bad now, they're going to need them even worse in January, because there won't be any new crop beans in the southern hemisphere until March.
And corn's kind of on the other side of that. It's not as strong, I guess.
It's not as strong. There is a slight inverse in the corn market. For the next 2 delivery months, not so much, but then 7 or 8 cents. So yes, it's there. Yes, it's a little bullish, but not jumping up and down bullish like the soybeans are.
Do you think there's less corn available on farm? I mean,
the commentaries that I read say that the reason the market is doing what it's doing is that we just don't have the demand for corn. The demand rationing has taken place for corn, and you know, here, as far as I'm concerned, here in Cass County, Nebraska, there's very little corn went into bins at harvest time. Most of it went to the elevator for the purpose of having a real good, accurate record for crop insurance purposes, and I think a lot of that got sold. If it did, why, we could see some tightness in the corn market, but it'll probably be April, May, June in that time period.
Let's move back to the dead cat bounce. We're still in the beginning stages of it, but still a ways to go.
I look at how much bounce there is in the price and how many days. Well, as of the day we tape this, there's 6 days, so we probably got at least 4 more, or from the weekend probably at least 2 or 3 more, and $1 a bushel off the harvest low. Now, if you want to go percentage-wise off the harvest low, it's about $1.33 or more. So you kind of look at your absolute cash price, look at how much of a crop you had, and what your cash flow needs are, and make your judgment call there. I've been kind of bullish here today. It's probably no big secret, but I would not try to discourage anybody from selling $15 beans. I mean, all of our lives we've heard beans in the teens. Well, today we have it. What are you going to do about it?
I told you before, I think that's the sentiment, though. I think popular sentiment is, let's wait a little longer. We still have some time here. The window is still open until South America goes. But do you think that's a little risky?
Well, no question that there's some risk in it in terms of what could happen.
Right.
The other side of that is what probably will happen. And I'd say we probably have at least till the end of the year to take advantage of beans in the teens, and you know, that's no guarantee. I wish I could. If I could, I would, but you know, you look at all those factors and make your judgment call, and I would say it's going to be nice this year because it looks like the price might go high enough to offset the loss we had in yield. I mean, I talked to some people who farm in dryland areas that were talking 20 to 25 bushel soybeans and 70 or 80 bushel or less corn. And if under those circumstances, you need the bounce.
Next week, we'll talk with Mike Briggs for his thoughts on the cattle markets. The USDA says the market for agricultural goods is about to get stronger. The United States-Panama Trade Promotion Agreement goes into effect Wednesday, the 31st. Immediately, duties on half of U.S. farm exports will be eliminated, with the others being phased out over the next 15 years. Panama is a growing buyer for ag goods. It purchased $504 million of agricultural products in 2011. That's more than double the buying it made in 2005. Top U.S. farm exports in Panama were corn, soybean meal, wheat, rice, and horticultural products. The USDA says this agreement, along with those for South Korea and Colombia, will bring an additional $2.2 billion in agricultural exports. As we've mentioned in many marketing interviews, the EPA will decide in November on a waiver to the ethanol requirement of the renewable fuel standards. One side argues using corn for ethanol drives the cost too high for feed, but some analysts believe a waiver wouldn't do much to ease price. Either way, there's a market for ethanol and there's a market for dry distillers grains made in the process. But as we look 5 to 10 years ahead, how will the demand for those two products affect corn price? We talked with Dennis Conley this week about how different ethanol blends and DDG export markets could drive corn in the future.
If we actually look at the 10% blend, what they bumped into was what was called the blend wall, which would be about 14 billion gallons a year. The renewable fuel standard is 15 billion gallons. So they raised the blend wall and said you could have a blend of 15% ethanol in your gas supply. That raised it up to 21 billion gallons.
But there is a wall that you can hit, and that means that there's also a number of gallons that you can hit.
That's right.
So what's the difference there between production from the low end to the high end?
The difference between production would be probably in the 14.5 billion gallons to the high end would be 21 billion gallons. Now, there's a lot of things that have to be in place in order to get to 21 billion, so we think it could come out somewhere between, say, the 15 billion and the 21 billion gallons.
This summer we read a lot about ethanol plants in Nebraska getting hit hard because they weren't making enough money. Some had to close down for at least a short period of time. When you look at the margins, what are the margins for the ethanol plants in this state?
In Nebraska, and we'll use Nebraska as a proxy for all the major producing states, you go back 5 or 6 years and they had great margins. But in the last year or two, those margins have become less and less. And as we look for this year at the margin for ethanol, it's actually negative.
And what's impacting that? Because you're getting DDGs and you're getting ethanol. Is there anything that can bring it back up or anything that's saving it from being worse?
Yeah, you said the key words there. It's now two products, ethanol and DDGs. And the DDGs still have value as co-product. So when you combine the two margins, you're actually still getting a positive gross margin and a positive net margin.
The DDGs are therefore buoying it a bit.
The DDGs are keeping them alive.
As with any import or export from the U.S., the strength of the dollar makes a difference. The strength of the dollar right now isn't that strong. On the other side, China is seeing an appreciated currency. What happens if that continues? Not only China, but Canada, Mexico, if that currency continues to appreciate and the dollar doesn't, how does that affect the import market?
When you have a weaker dollar and stronger foreign currencies, China, Mexico, Canada, South Korea, other countries, which we have had for the last 10 years, our exchange rate, corn traded exchange rate, has been declining for the last 10 years. That means that those countries buying distillers grains, buying corn, buying anything, it's cheaper for them. They can get more for the same amount of money. And so that's a pivotal point here as to what does that exchange rate look like going into the longer term future.
And they capitalize, obviously.
They capitalize on that, yes.
Play out a few scenarios for me. One is if the U.S. doesn't meet that requirement, the RFS requirement, and that's what the USDA is projecting now, correct?
Mm-hmm. Yes. If we take the long-term projections of USDA, their figures for supply and disappearance of corn, their numbers are showing about a 14.5 billion gallons of ethanol production out to 2015, 2017. We take that scenario and we would come up with a set of prices over the next 5 years that would be pretty much in the new normal that we've seen in the last couple of years, the $4 to $6. They'd run from probably about $3.90 to $4.50 a bushel for corn.
If the U.S. does meet that requirement on the other side to 15 billion gallons, what does that do to the price of corn?
Just raising it a little bit, a 500 million gallons, then the price for corn on the projections would go up, probably about another 50 cents to $1. So now we're talking about $4.50 to $5 range for corn. Not right away, but when we're looking at maybe 3, 4, or 5 years.
Is that the most likely scenario?
That is the most likely scenario. You know, if I had to put a percentage on it, I'd say that's probably a 60% probability of that scenario.
If they blow through that on the other side and they surpass the RFS, what does that do to the price of corn?
If they blow through it, or really not even just blowing through it, but let's say they go to 15 billion gallons and this export market develops,
sure,
as we are projecting under declining exchange rate, increasing feed demand in developing countries, the ethanol goes to say 16.5 billion gallons, just a 10% increase over the standard. Then we're looking at what I would suggest is a second new normal. We're talking about prices that will be in the range, price of corn that will be in the range of $6 to $8 a bushel, looking at about 3 to 5 years, 2015, 16, and 17.
You can see our full interview with Dennis on the Market Journal website. Historically, the first hard freeze of the year occurs on average around Bloomfield on October 1st. The latest arrives on average October 28th near Nebraska City. We talked with Bruce Anderson this week about forage options and sampling and how the first hard freeze of the season affects alfalfa.
Well, there's a couple of things that the freeze tends to do for us, both from haying and grazing standpoints. If we're looking to be grazing that alfalfa, especially maybe grazing it alongside an existing cornstalk field, we want to make sure that we can do that safely to not end up with too many bloat risks and things like that. Typically, a good hard freeze will often make the alfalfa change its overall physiological and chemical makeup so that the bloat risk goes down a great deal. It especially goes down if we start noticing that the plants are starting to yellow a bit, or especially if some of the leaves are starting to dry. That's a good sign that the risk is quite a bit lower under those situations. If we're looking to take a final cutting of hay, the freeze pretty much signals that the plant is not going to be sending too many nutrients more down into that root system, so that we're going to be able to harvest that crop, get it off the field without much risk of doing any more damage or reducing its ability to winterize any more fully.
Staying in alfalfa, any chance to get a jump on weeds here?
It's a good time.
Hard freeze?
This is an excellent time to take care of weeds, especially in those fields that may have a history of winter annual weed problems like mustards, pennycress, cheatgrass, or downy brome. From now until the soils freeze is a good time to use some of the dormant season herbicides to control those weeds, so that those fields that have problems with those weeds in the springtime no longer will be a problem next year, and we'll have better yields and especially better quality from that hay.
Probably seen a lot of cattle out on corn stalks already. Is there a management decision or a management time frame that you look at and say, well, maybe I should think about how long I'm going to be able to leave these cattle out here as we look into maybe early next year?
Well, we're going to be certainly looking at just what our total supply is of feedstuffs that we have for the winter. A lot of people are going to be really stretching their feed as far as they can because the drought has certainly shortened some of our harvested feed supplies. Looking at what supply any individual may have, they could have a couple different strategies for use of their corn stalks. If they're trying to stretch it as far as they can, probably their best strategy is to give just little strips of corn stalks at a time, a week, 2 weeks worth at a time. Make sure that the animals use it up fairly effectively before going on to another strip. If they have plenty of corn stalks for the cows, they may give them a larger amount at any one time, let them really pick over the very best parts of the corn stalks, the leaves and husks, and not force them to eat any of the lower quality material. That'll keep the animals in a little bit better condition, probably result in less expense in terms of supplements that they'll need to take care of the animals.
A lot of forages in play, I'm sure, this fall and into this winter. What do you recommend for testing? If people haven't done it yet, what are you looking to test for?
Well, I think we want to be testing just about all those maybe strange forages that we've got out there. A lot of people, because they're trying to get a lot of different forages and come up with a supply, are using things like maybe CRP hay or roadside hay or drought stress corn silage, things that maybe they haven't used very much in the past or might have a lot of variability in terms of the nutrient content. So among the things that I am looking at mostly for testing, certainly anything that has some potential nitrate risk, we want to make sure that we get those nitrates tested for, so we feed these things safely and don't put risks of any livestock losses due to nitrates. Then after that, testing for protein and energy content so that we can use our supplements and our forages most efficiently and economically, because everything's so expensive this year. We don't want to be overfeeding, but we want to make sure that we're still keeping the animals in good condition so they'll produce properly for us.
For help interpreting your forage sample results, we put a link on the Market Journal website that can help you understand the feed analysis. Another problem is emerging due to the open, dry fall. In the October Nebraska Farmer, you can read how winter annual weeds could flourish this fall. However, the open fall also provides you the opportunity to get on top of the winter weed surge now rather than waiting until spring. UNL Extension weed specialist Lowell Sandell says the widespread adoption of no-till offers a good environment to germinate weed seed. You can read more about the issue in the October Nebraska Farmer. If you've insured your rangeland in the past and plan to do so again, you may be aware the USDA has made some changes to the coverage. Aaron Berger talked with us earlier this week to explain the new Rainfall Index program.
Well, the changes this year, the USDA RMA has moved the pasture range and forage insurance from what had been a vegetative index, which was based on looking at historic satellite imagery photos of forage during what we would consider the growing season, and then comparing the color of that satellite imagery to historic averages and then determining a loss based on that. For 2013, they're moving to what's called a Rainfall Index, which is based on precipitation in 2-month intervals. And so that's the change this year from what it has been for 2012 and some years prior when this was a pilot project.
And it's not an either-or, correct?
That's correct. As I understand it, for 2013, it is a rainfall index, which is based on precipitation. It's single peril insurance, meaning it's not based on loss due to hail or anything else on pasture range or forage production acres. It's simply on precipitation.
And how is that rainfall measured, Aaron? Because obviously precipitation varies from location to location.
Right. The way the insurance works, as I understand, is it's based on, you look at some grids. They have grids all across the state. You find where your acres are at, and then you would insure your acres within that grid. NOAA is who keeps track of the precipitation information, and so depending on where you're at in that grid, they are insuring, or you're basically insuring your acres with the whole grid. And so it's possible that you could have dry conditions on your farm or ranch, and the rest of that area that you're insured with could get above normal precipitation and you wouldn't get an indemnity. Conversely, though, it's also possible you could have a cloud burst a few times over your particular acres, and for that grid, maybe it's drier, and so you would get paid when others around you maybe didn't get the precipitation they would have normally gotten. So I think you need to just realize over the long term, I think it washes those things out if you take insurance consistently. for individual years or two, you could see some differences that maybe don't correlate with what happens exactly on your place with the grid as a whole.
Let's talk about the qualities of the program, Aaron. Are there the different levels of coverage? What are they? And are there different options for if you're going to use it for haying or grazing?
Right, there's really two options. You can pick grazing or haying. Haying has a much higher value than grazing because they're expecting those acres to be higher levels of forage production, which you would harvest for hay. So you want to pick whether grazing or haying, and then you want to pick your level of productivity. They have some county averages or state averages for those particular acres, either haying or grazing. And then you select that level of productivity. It can be anywhere from 60 to 150%. And so you want to look at that and say, based on what I think my productivity is of my land, how does that value compare to what I expect? And then you might adjust it accordingly. And then the level of coverage is anywhere from 70 to 90%. And so you can pick anywhere from 70 to 90% of precipitation for the months that you want to insure. Now it's broken up into 2-month intervals like January, February, March, and you have to pick at least two 2-month intervals, and you can't insure more than 60% of your coverage in any one of those 2-month intervals. So as we look at precipitation for Nebraska, when it affects forage production, really for us the critical months, depending on where you're at in the state, are March through July. March, April, May, June, July are those critical months. And so I really encourage people to look at those months and think about breaking those up in terms of where they might want to put their insurance coverage in. You can only insure 60% of your coverage within a 2-month period. So if you say, I think April, May are really the critical months for me, you might put 60% in those 2 months and then 40% in June and July or something like that. The other thing is important to understand is that USDA Risk Management Agency has decided that this is a program they want producers to engage in, and so it's subsidized to some degree. If you're covered at 90%, it's subsidized by 51%, meaning the premium, you pay 49%, the Risk Management Agency covers the other 51%. At 80 and 85% coverage, they'll actually cover 55% of their premium cost, and at 70 and 75, they'll cover 59%. And so as you run some scenarios and you think about your options, you need to think about that as well in terms of what you get in return for the dollar you spend.
If you're interested in seeing how the new rainfall index would have worked in past years, Aaron has a webinar on the Beef website that uses historical data scenarios. The deadline for participating in the Pasture Rangeland Forage Insurance Program is November 15th. The crop and livestock industry are tied tightly together. Corn and soybeans make up a good portion of the feed that animals need to grow. But another species is also finding an increased appetite for soybean meal. A larger demand for fish is opening an aquaculture market that needs a valuable feed source. On KRVN last week, Mark Caspers from the Nebraska Soybean Board outlined the growth in that sector.
The inclusion of soy meal in the aquaculture diet has increased nearly 7-fold, up from 1994 to 2007, increased nearly 7-fold then, and looking forward to a bright future of getting a lot more inclusion in the diets of the fish and marine animals. It's a growth market in the U.S., but China and Asia is kind of leading the way on that, and that's where it becomes really important to us because about 78% of our meal exports are going into Asia.
Now to forecast the coming week, here's UNL Extension State Climatologist Alan Dutcher.
Well, folks, here we are again for the weekly forecast. Before we get to the main forecast, of course, let's do a brief summary of what happened in the last 7-day period. And of course, the big news was that we did see a system move through the center part of the country during the midweek period, and it is pivoting slowly toward the eastern seaboard and expected to merge with Hurricane Sandy that's running up the eastern seaboard to create a pretty powerful storm over the northeastern United States. For us proper, what we've seen was anywhere from 2 to approximately 4 inches of snowfall, very common across the Panhandle, north central, and even into northeastern Nebraska, with the snow line making its way down to about halfway between Grand Island and Broken Bow, and then south of that was more in the area of just basically rainfall with some scattered thunderstorms in the east. So overall, we were looking anywhere from about 0.2 of an inch equivalent moisture across portions of western Nebraska to approximately 3/4 of an inch in some of the thunderstorms that hit eastern Nebraska. Now, we're not expecting any significant moisture during this next 7-day period, but we'll be turning our attention late in the period to another storm system moving into the western United States that may actually start to impact us as we go into next weekend or early in the following week. So let's take a look at the upper air models and see what we can expect in terms of our weather as we go through the next 7-day period. And I'll draw your attention to here is the upper air trough with a very cold air sinking in. It's going to be a very, very cool day today. If you're going to the game in Lincoln, of course, against Michigan, expect that by game time we'll be seeing temperatures that will probably be in the low 40s. By the time we get to the end of the game, we're probably looking at the upper 30s. And we might actually see a few flurries as a piece of energy moves across. It doesn't look like any significant moisture, but we may see a few sprinkles make it to the surface, particularly as we get past the midnight hour. Now, as we go into the day on Sunday, we're going to see Sandy making its way up toward the northeast. Here comes this trough starting to really dig down. That's going to keep the cool airflow into our region. We're not expecting anything in the way of moisture, so we'll see a slight rebound in temperatures with just a chance for some scattered sprinkles across extreme northeastern and east central Nebraska as another piece of energy pivots around this upper air trough. And then as we get into the day on Monday, this system starts to energize, pulls Sandy together, and starts to bomb out in the northeastern United States, deepening, and we could see 2 to 3 foot of snowfall before the system is all done in the extreme northeastern United States with some heavy wave action and flooding rainfall all along the eastern seaboard. As we go into Tuesday, we'll see this ridge building in our region, starts a warming trend ever so slightly. We don't expect any precipitation, just one little wave that might bring, again, a chance for flurry activity across eastern Nebraska. Now, as we go into Wednesday, it looks like the ridge builds in, and one more piece of energy pivots southeastward that might again bring some scattered precipitation in northeast Nebraska. Again, looking at very, very light totals. As we go into Thursday, now the ridge starts building in our region. We get much warmer temperatures, and as we get into the day on Friday, here comes the next approaching trough that may bear watching for possibility of accumulating snowfall. 8 to 14-day forecast brings cool conditions to the east in terms of precipitation. We are looking at a dry trend to our south.
Thanks, Al. As always, you can view any interviews you may have missed on our YouTube channel or on the Market Journal mobile app. Next week, Mike Briggs is our marketing analyst, and we'll look at House and Senate Farm Bill versions based on Nebraska farm data with Brad Lubin. Until then, thanks for watching. I'm Jeff Wilkerson. We'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Facebook and Twitter. Promotional support is provided by the Nebraska Farmer Magazine. Funding for Market Journal is provided by the Nebraska Soybean Board. The Soybean Checkoff, growing opportunity from the ground up. Market Journal is produced by the University of Nebraska Lincoln Extension, where you can know how, know now. Funding for Market Journal is provided by the Nebraska Soybean Board.
Animal agriculture is vital to Nebraska. Livestock production not only contributes to our food supply, but also helps our rural communities. Livestock provides revenue for schools, creates jobs, supports Main Street, and enhances the future for farm families. The Nebraska Soybean Board's Animal Agriculture Initiative works to encourage growth of responsible livestock enterprises to benefit agriculture and Nebraska.